Today, I'd like to present the Europe's small and microcap opportunity. Um, so today, we find that a very compelling opportunity in Europe, um, largely based on the confluence of two major dislocations. One is that Europe itself is underweighted in global commercial indices. And that's largely at the expense of the US being significantly overweight for valuation reasons and also free float reasons, which we'll discuss in further detail. Um, and then related to that also is that Europe is undervalued relative to its fundamentals. So over the past 4 years, valuations in Europe have barely budged, even though fundamentals have improved. And this is especially true amongst Europe's small and micro-cap companies. Um, so over time, going forward, any potential unwinding of the hyper concentration of global indices in the US, largely stemming from concentration in tech, to the extent that starts to unwind over time, we believe that could potentially favor international markets and primarily also benefit Europe, given its underweight and also its relative undervaluation relative to Europe's attractive fundamentals. The other aspect that's also occurring is that in Europe and also in the US, the size and value premiums, which over long horizons have been positive, have actually been negative since 2007. Um, and that is since 2007, that has coincided with essentially the rise of big tech and also um, um, the massive innovations that happened in the healthcare sector in Europe. So as a result, value stocks have been out of favor relative to large growth, and coincident with that, small and micro caps have also been out of favor, especially in the US and Europe. To the extent that there's upward mean reversion in the size and value premiums, which should be positive, right? Because small caps and value stocks are inherently riskier, so therefore they should have higher expected returns. Those premiums should be positive. So once those premiums turn positive, European deep value microcaps especially stand to benefit the most from upward mean reversion in the size and value factors. Um, and ultimately, we're very, very excited about this opportunity, and we think that the biggest room for upside is in European deep value microcaps. So I'll start with the allocation opportunity in Europe, looking at the weightings in the global commercial benchmarks. So today, in the US, just to set the stage, looking at CAPE valuations, and the CAPE is essentially the cyclically adjusted PE ratio. So looking at the price of a market relative to long-term earnings over the past 10 years. And today, the United States CAPE ratio is 36, which places it quite firmly in expensive territory. So in this analysis, we looked at historical CAPE ratios for the United States all the way back to 1926. And we grouped those CAPE ratios into three categories with an equal number of observations, and tagged them as cheap, moderate, or expensive. And quite clearly, the CAPE ratio of 36 today is firmly within expensive territory. I mean, these are levels that were last seen in the dot-com bubble. And also, interestingly, from a CAPE standpoint, valuations today in the US are higher than the Nifty 50 era, which reached its peak in the late 1960s.